Guys, I don't mind saying it. It has been a very difficult 4 months in the market. I have lost, I'm going to say it, I've lost over $200,000 in the last 4 months in my personal account. But I am excited to report in the last week alone, I have made back as much as 70,000 of those dollars. This is a trader's market right now. And today I have two of the world's best options traders here in the room to report the situation. We've got a lot of charts to show you guys today, to show you what the opportunities are out there to the long side and the downside. We're going to talk about a potential catalyst that could send the markets way, way higher, starting as early as today, Wednesday, March 2nd. So let's get right into it. Before we get into the charts, guys, I just want to ask, Russia, the big topic right now. Do markets fundamentally care about what's going on in Ukraine? Is it a short-term reaction? Are pundits accurate in making early calls for World War III? Are they just calling attention to themselves for the sake of clicks and audiences? Are they going to create a self-fulfilling prophecy where they actually start a full-blown war? Has Putin gone mad? Has he just been stuck in his room for the last 2 years looking at old maps, trying to redraw borders? Chad, I'm going to turn it over to you. What is your take on the Russia situation?
I mean, there is a lot going on. It's a tragedy over there. I know people, I have a good friend that coaches our kids that has his sister in Ukraine, and she's been living in a bunker for a week now. So and they don't even have real bunkers. She's living in subways and that sort of thing and kind of moving around, but like just totally out of the norm. So it's very sad what's going on over there. But yes, the media has given it a ton of attention, and I mean, rightfully so, but from just a global perspective, taking in everything. But as far as the market goes, it's not necessarily going to have to hold back the stocks, the U.S. stock market and that sort of thing. So that's why a lot of this stuff, when it goes on, even tensions in the Middle East that blow up from time to time. This is in Europe, so it's different and it's new. But I stick to my strategies. I'm going to continue today. We're going to do the same thing we do basically every month. And I'm going to talk about a bullish trade and a bearish trade, but we're going to start at the sector level, and then we're going to take a few stocks and have ways to trade this that way. And that's the great thing about trading too, is that we can take both sides of the market. So
we absolutely can. If
we're seeing the market go down, we can profit from that. And if the market rips higher, then we can profit from that too. So, I'm not, I'm still on the fence as far as how this is all going to play out. I'm not calling for World War III or anything like that. It's definitely a lot of hype in the media, and we see, kind of one side of it. We have a lot of European friends too. And, they said that just even in Europe, the news that they see over there is a lot different than the news that we're seeing over here. And then just imagine if you're in somewhere in the Middle East or Asia, it's going to be totally different on how they're portraying everything going on. So it's just kind of depends on your perspective as far as the immediate impacts of this thing. But right now, I'm going to continue to trade and continue to take both sides of this market because I've been winning with calls, winning with some puts.
Absolutely. I agree with you 100%. I can't wait to see what your opportunities are today, Chad. But I've got to get Mike's take as well. Mike, you single-handedly beat the Russians 35, 40 years ago during the Cold War. You're a Cold War hero. Okay, maybe you didn't single-handedly beat them, but you did play a very significant part. What is your take on the Russia situation? Where do you think we go from here?
So in the long run, this has fundamentally changed the next 10 years. I don't know how we go day to day right now. And that's a challenge for me because my focus is short term. Like you mentioned, the market's down for the year. Accounts are taking a beating. This is the kind of market where I just sit all day. This is why so many of my articles are late, just day trading the futures market. So if you could tell Russia to stop, you'll increase my timeliness. But looking at the long term, we responded with sanctions, kicking them out of SWIFT. We weaponized the dollar. Other countries are noticing that. And you're going to see an alternative to SWIFT develop in the marketplace. And this alternative to SWIFT is going to displace the dollar as the world's reserve currency. So all this is in motion now. And Russia caused that. It's going to take years to unfold. But Chad, I know your kids are younger. In their lifetime, the dollar is not going to be the reserve currency. And we can look back to this week and understand why.
Mike, that's a really, really bold claim. For people who don't know what it is, can you explain what SWIFT is?
So SWIFT is like the email system for money. When you go into your bank and you cash a check or you send whatever the kids use, what's it called? Venmo, whatever they're doing
Venmo,
with that
yeah.
electronic stuff. Excuse me, on the Twitter and all that stuff. Whatever the kids are using electronically, that's all going through the SWIFT system. It's a global connection of all banks. And it has become the global standard for processing payments. It displaced basically gold. If you think back to the gold standard in the old days, if Spain brought something from France, they sent a shipload of gold over. Nowadays, it's just 2 clicks on a computer, and it uses the SWIFT system, so displaced ships. It's granted the US this basic place in the world where we control the financial system. And that has given us the ability to issue debt to pay for things that are good and bad. Both sides there get a shout out. And we've taken that now and we've put that at risk. So if we can no longer issue debt at low rates, the US is facing a significant challenge in the years ahead. And this isn't tomorrow, this isn't even the next 5 years, this is in the next 10 plus years. So Putin has changed the world order. It's likely China is going to play a prominent role. It's likely the US is going to play a diminished role. There's probably going to be a new Cold War between the US and China. All weapon systems are on the table, including military, nuclear, financial, since the dollar is now a weapon, cyber warfare, space warfare. So it's going to be a very dramatic future. And it all started when Putin rolled those tanks across the border and the US had not acted strongly enough to prevent that.
So help me understand how the dollar is at risk. Is it because we're raising rates and that's why we can't issue debt at a lower cost? Or is it something in the way that we've weaponized the dollar in the past week? Help me understand this.
So right now, when we issue debt, we issue it in dollars, and we control the value of the dollar because we decide how many get issued. We control the global financial system with our lock on dollars. Other countries issue debt in dollars. I just saw an article, Russian citizens were taking mortgages backed by dollars rather than rubles because the dollar was more stable. The dollar has been the global currency of choice since the end of World War II. Prior to that, it was the British pound, and that allowed Britain to get its global empire. Prior to that, it was the Dutch guilder, and that allowed the Dutch to colonize the New World. So a small country, the Netherlands, because their currency was so powerful, they were able to become a world power. That was then followed by the UK and now the US, each which rode their currency to world power. I mean, the military is a part of it. If you can't issue currency in dollars, or if you can't control the dollar, you're at the whims of the world market. Think of Argentina. When Argentina had to issue debt, because the dollar played such a central role, when the value of the Argentinian currency collapsed against the dollar, Argentina defaulted. If we're subject now to the whims of the marketplace, the US with its debt to GDP ratio is subject to default. It's the same problem. The ultimate example of the problem of debt in another currency is the Weimar Republic after World War I, when Germany's currency collapsed and people burnt German marks instead of buying wood because it was cheaper to burn the marks than to buy wood for heating.
So by weaponizing the dollar, we've essentially invited undue volatility to it by making it subject to the whims of global chaos. Is that what you're saying?
Correct. China's going to step into that void, and China has been colonizing with financial stuff Africa and Latin America, their Silk and Road initiative. So China is going to set up an alternative to SWIFT that African and Latin American nations will have access to. Russia's already accessing that. North Korea is accessing that. So it's going to be bad guys in the developing economy against the US dollar. And it's going to tip in favor of the bad guys in China at some point in the future.
Okay, wow, we've got a lot of very big stuff to cover here, clearly. And it sounds like we're going to have no shortage of opportunities to trade, because the kind of stuff you're talking about could create a lot of volatility in the markets, and you can make a lot of money from that. So let's go ahead and get into the charts. Let's get into them right now. If you watching this video, if you like this video, please like, comment, subscribe to our channel, True Options Masters. We do these monthly market outlooks every month, first Wednesday of the month. And of course, we publish True Options Masters 7 days a week through our online email letter every day at 11 a.m. So let's get right into it. Mike, I'll turn it over to you if you want to share your screen and go through what you are looking at today.
Okay, so you should be able to see my screen now. This is the chart I always start with, S&P 500. This is the 50-day moving average. This is a price target that was established some time ago. So there's a symmetry to the markets. This is a 50-day moving average. When price moved above its 50-day moving average by the maximum amount, we had the rubber band stretched as far as it could go. So when you stretch a rubber band and then you let go, it's going to snap back. The snap back, we just assume it's going to be equal to the original tension. And that sets the price target here. So the distance above the moving average is then plotted below. That did stop the decline in January. And I think the market was on its way higher when we had this global situation collapse on us. We came down, that level was violated. We got right back above it. Could be just a trap here, trying to suck the bears into the market, telling them, you know, look, we're on the way down. But the way it bounced back, that's a sign of strength. We're bouncing higher today. Every reason to believe we could continue moving towards that 50-day moving average. After we do, that same technique here is projecting a price target of about 489. So we have a lot of potential upside on the S&P 500.
Well, you're saying we could actually see new highs in the coming weeks.
Coming months. Yeah, it's going to take time to get there because new stories are going to give us setbacks. It's going to be volatile, but we're going to climb higher. I think this support is going to hold in the long run, but we may test it one more time.
Okay. And I see you've got IWM and QQQ pulled up here as well.
Yeah, so this is a chart that's basically showing the sweet spot of the market, and we're far from the sweet spot. So
and Mike, please correct me if I'm wrong, is what I'm seeing here at the bottom, is this your new and improved peak velocity indicator?
It is. So what I've been working on is identifying just the sweet spot, that area where the trend is defined and the risks are relatively low. So what we want to do is just get in and just grab those little short up moves. It's not perfect, but it helps us to identify the lowest risk situations in the market. So red is high risk, yellow is a warning. Green is you are in the sweet spot and you should buy calls on triple leveraged ETFs. You know, you're that kind of a market. And you shouldn't, that was not financial advice, but you know, you should be aggressive when it's in the green. We're very far from that, which indicates we're going to have a lot of volatility unless we get a news catalyst like potentially OPEC is meeting today, OPEC plus. Saudi Arabia has a lot of spare capacity. If the OPEC meeting results in a large increase in production, we should expect the market to rally sharply. That would push oil down, stocks up. This would go green probably in the next few days. So this is just to show how much technical damage has been done. And then just looking at IWM, improving here. The sell-off has been an opportunity for risk takers to kind of jump in and find their positions. IWM has been a laggard for some time. We're starting to see a lot of interest in it. And potentially, I think this is going to be the leader in the next rally. Tech stocks, which have been the leader for some time, the technical damage is so extreme here that it's going to take a lot of time to recover. So as the rally starts, I'd be looking to small caps and increasing exposure to IWM and the micro cap ETF IWC.
IWC, that sounds good. I actually didn't know that there was a microcap ETF, but you may have just given me my new favorite thing to trade. Chad, I might want to get your take here for a second. So I've been trading IWM and QQQ a lot over the past week, watching these indexes every single day. Chad, I know that you bounce around and you trade all of these indexes in fast lane profits. What I've been noticing is that the last week or two, the Dow, which is typically the least volatile index, the most stable, that's been the one that's been actually going down the most, followed by the S&P 500. And then actually the ones that have been holding up better are IWM, the Russell 2000, and QQQ, the NASDAQ ETF. Do you think it's because these indexes are already so beaten down? Is it because the Dow and the S&P 500, but the Dow especially, are so subject to geopolitical, gyrations? What do you think is going on here, Chad?
Yeah. I mean, I would give it to the geopolitical aspect of this, and the fact that Dow is a little slower to react because that's the 30 basically largest stocks in the US. They're industrial type stocks, so they're not as fluctuating as like a tech stock or some of these other stocks that would be in the IWM and the S&P 500, even with the 500 largest stocks. And because of that, because they're like the 30 largest stocks, they tend to play catch up. When you look back at some of the crashes, they usually don't start with the Dow. It's more of a safe haven, a little slower play. And then once they realize that there is some fear on the table and all that, then the Dow starts to pull back usually. That's kind of the second line of defense. But yeah, I mean, that's a great perception there on kind of how these indexes work. And it's definitely not they don't all move in tandem. That's what the best thing about this, our strategy is that we just try to pick the one that's going to be moving the most in the right direction, from day to day, jumping into them.
Well, I was looking today in the first half hour, Russell 2000, it jumped up 1.6%, QQQ today. Well, it's been pretty volatile, but it went up almost a full percent. Whereas the Dow, and just looking at that, okay, the Dow is looking a little cleaner today. So yeah, and Chad, I know you really like to look at these things on your profit radar because you're able to see which ones are leading and which ones are lagging at any given moment. And we're going to look at that in a second. But Chad, I'm wondering, in fast lane profits, can you tell us which index that you're trading right now? Which trade are you in? I mean, you don't have to give away the exact option.
Yeah, no. Right now we have put options on the S&P.
Okay.
So it's been very active. So it's every day or two we're basically flipping from puts to calls and trying to get in on the next big swing that the market's going to see. Because once these things either take off, once we see the big move to higher or another drop, I think we're still in a lot of volatility. So we're going to see big moves. So it's just a matter of catching those. So right now we're in puts. Tomorrow that could change. Puts on the S&P today. But the market's up today, so we'll see if we get some weakness here in the afternoon. If not, then tomorrow will probably be enough to trigger a bullish trade, flipping back to calls.
And I know when you make an index trade, you also drill down and you find what you think is probably going to be the number one stock leading that move down or up if it's a call option. I know you can't give away that exact trade, but I think you've probably got some opportunities for us today. Isn't that right? Yeah.
And our opportunities today are not as short term. So it's okay if you catch this video a couple days later. What we're talking about today is trying to play out throughout the month and trying to position for a month instead of from the day-to-day swings that we see. So that's a lot of volatility, but then, even like, what was it, the day last Thursday when the market opened, was it Wednesday or Thursday? I think the market opened down, the Dow was down like 800 points and it closed positive. So there's a lot of intraday moves, but if you're holding for the whole week and you just sit tight and don't panic, you didn't lose out on money if you were bullish the day before, because it ended up being positive and just a lot of volatility though. Some patience, especially if you have time in your trades.
Okay. All right. Well, let's go ahead and get into it. Chad, go ahead and share your screen.
All right. Pull up Optima. All right, so here's the sectors that we track, the daily rotation graph. Again, quick recap on the this rotation graph that we use that I call my profit radar. Basically has 4 quadrants: the leading, weakening, lagging, and then improving. And then we watch these sectors as they rotate around. What would be in the center of this is the S&P 500. That's basically the market that we're tracking. So looking at how these sectors are performing based on their relative strength to the S&P 500, and then the momentum of that relative strength gives us this rotation, and we can just scroll through just to see what it looks like through some of this year. So you get the idea that we try to catch these as they're making this turn out of the lagging and heading towards the improving and leading quadrants. So making this rotation to the north, northeast, and heading up to leading. But then today I wanted to talk about that we don't always have to be bullish. We've been bullish, we've been very optimistic going back. Last month, it was consumer discretionary stocks that we were in. They didn't really work out. It was volatile, it was choppy, nothing really tanked, but they didn't make you money. So they weren't the right plays to make. And you can see that it turned lower, about a week and a half ago, this consumer discretionary line turned lower. So even though, and then that goes to show though, that even though it's improving against the S&P 500, it doesn't mean that it's going up yet, because the S&P 500 has been volatile. It's been going down. So we're still losing money, even though it may have been improving against the S&P 500. So for today though, when we zoom in, we look at the sectors, the one that I'm bullish on is going to be the technology sector here. It's just made this quick little turn higher. So we wanted to try to catch this and see if it's going to be the start of a bigger move. We see that we have utilities and green, industrials, and real estate. They're already all kind of making this rotation. They're pretty far into it. So they're going to see some weakness and some pullback more than likely sooner than later. And then for the bearish trade that we can look at today, though, it's going to be materials sector, because this is already kind of making this turn, and now it can fall through weakening and then lagging. And all that time, it's expected to show weakness relative to the S&P 500. So you could look at consumer staples too, but some of these material stocks are going to be the ones that we're going to have on our radar today. So heading into this month is materials and technology, bearish on materials, bullish on technology. And then as we break down these sectors now, we put the tech sector at the middle. So the sector ETF for technology is at the center of this chart, and then I plotted all the companies within the XLK on this chart, so that way we can see how they look relative to the technology sector and get our stocks that we expect to make the biggest moves here over the next couple of weeks. So the 3, I always throw out 2 or 3 just because the way that these rotate, you never know which one's really going to take off. But this is the sweet spot, I guess, as Mike would call it, for his strategy. It's the same kind of thing here. This is a sweet spot when you want to take a look at these to try to get in. So one of the companies today is ZBRA Technologies. And just pulling up the chart on this one, just to show you that we know tech stocks have been beaten down, but these stocks have been taking a pretty severe beating, falling sharply. This is true for all the ones that we're looking at today. But now they're at that spot on the chart. We're seeing technology starting to improve relative to the S&P. And then as these stocks start to improve relative to the tech sector itself, we expect to see some big moves here over just the next couple of weeks. So it's not long-term plays that I'm talking about. We're talking about just a matter of weeks. Another stock is ADBE. And the other one, I'm just going to zoom in a little bit. You can see Akamai Technologies starting to make this turn, but it's still kind of northwest. It's not pointing northeast yet, which is really the rotation that you want. Because as you watch these things, I've rolled through hundreds of these charts, just scrolling through and looking at the rotations. But you'll see some of them start to turn kind of like Akamai Technologies is, and then it'll roll over again and head back down deeper into the lagging quadrant. And that's true. It could still happen for a stock like ADBE also, but it's less likely. You don't see it as often. So our third stock today is going to be Oracle. It's a larger cap stock, but it still has been crushed here over the last couple of weeks, starting to turn higher now. So it made this sharp little turn higher here on this profit radar for the tech stocks. So we're going to have that as our third stock in the technology sector to keep an eye on. So again, that's ZBRA Technologies, ADBE, and Oracle Corp for our bullish 3 trades to keep an eye on. Look for opportunities with call options to play those just over the next couple of weeks. And then our bearish trades. So this is the materials sector. And now we're looking for basically flipping it, looking for the stocks that are in the leading, headed to weakening, and then lagging. So the ones that stand out here that are the farthest over are Freeport, McMoran, and Nucor. So they're both commodity plays. One's steel, one's copper. And their charts are basically the same. They're making higher highs, higher lows. So it's pretty bullish tough to be bearish on these trades. But again, this is not a long-term outlook here that we're trying to be bearish. We're seeing the run up, and we would expect a little pullback. That's what we would be trying to time over the next couple of weeks. And that's what this chart is basically telling us to expect. So out of these two, I would just take one of them as a play this week or as a play this month to look for a pullback in. And they're both pretty identical on the charts. So it doesn't really matter either one. They're probably going to trade similar based on the geopolitical news that's going on. If something happens for commodities where they're going to see a pullback, both of those stocks are going to kind of pull back in tandem. But then our other two stocks that I wanted to take a look at to add today are going to be Martin Marietta Materials, MLM. And when you look at these price charts, it's a little more bearish. I mean, this one was running higher, but then had to pull back, and then now it's consolidated. And you can see that I went through the shades here on the chart. It was lagging the market in red. Then it improved, but it didn't make any moves higher for the stock. And now it's leading the market technically relative to the S&P. This is relative to the S&P, but it didn't even outperform the stock. The stock hasn't gone up. It's holding lower. So that's some bearish indications here that the stock could roll over one more time from this point. So it's a stock that's going to be on our radar for a bearish drop. And then International Flavors and Fragrances, IFF. So that's the other stock that's going to be on our radar for a bearish play. And this one, definitely a pretty bearish price chart, at least in the short term. Lower lows, lower highs across the chart here. So it's in the downtrend, and it's already starting to pull back from some of the momentum that it had earlier through February, starting to pull back already. So we're just keeping an eye on this one to possibly break out to the downside and add some bearish opportunities to play this one. So that's all I have for this month, Chris.
I'm so glad you brought up commodities, Chad, because I think we're beginning to see a lot of opportunity there. And there might be a bigger story there than a short-term drop of the next month. I want to talk about technology again real quick. Can you go back to your technology chart?
Yeah.
So I had to pull up that one stock in just the Southwest right there, EPAM, that's just gotten absolutely murdered. Pull up this chart, this stock. This is insane. So here's a stock that's lost basically 2/3 of its value, and it's up 11% today. I think this is hilarious.
Yeah, that's a nice little bounce, and that's what you'll see in stocks like down here. I mean, they've been beaten down, so you get the bounces. Today's a bounce. I'm waiting for the turnaround. So even though it's headed down this way, it gets a bounce today, but that doesn't mean that it's actually changing momentum.
Right.
The rest of the market's kind of bullish today. Not overall, but like you mentioned, IWM was up, over 1% to this morning. So we're seeing some of these other more volatile stocks get a bounce. But that's why I avoid it for now. It's something I would keep on my radar though throughout the month. And then once it makes their rotation, then it's something that could be in play, but it could go, as far down here as it needs. So there's no resistance area when it comes to this chart. It can just continue to fall before it eventually turns higher.
Oh, and PayPal there. I zoom out more, you see one that's way off in the distance going higher.
Yeah, I mean, more volatility. The stock's been crushed too.
Yeah.
Falling down quite a bit and then just starting to show. And you can see that one, I mean, it's moving relative to the tech stocks, but it hasn't done anything on its price chart. So it's continuing to go lower.
I love this indicator, Chad. I think I tell you this, every month, but I guess I've had an impression that we're seeing a great opportunity in technology right now. I mean, me personally, I've been trading Square a ton. I own a ton of Square options right now. The stock popped 20% this past Friday. And I think we're going to be seeing a lot of those type of opportunities, or we might see certain tech stocks that have just been murdered, beaten down, just pop like that, 10, 20% in a day. So I think this is probably a very good month to be trading some calls on tech stocks.
Yeah, no, that was my
ideas.
That was my True Options article for, I think, last week, talking about how these stocks are down. I mean, Square is one of them, down 60 or 70%.
Yeah,
a couple of years. So, but there's dozens of them that are high quality company stocks that are fundamental. Their fundamental businesses are pretty sound. They got to turn some things around. They're volatile stocks, but what they're doing, their innovations, and the things that they're doing it's really cool stuff. And the companies are just polished here over the last couple of years. So it is a great opportunity to have those on your radar.
Yeah, I think so. The stocks I'm personally trading, I'm really going for it on those truly beaten down stocks. Like I'm trading Palantir right now. It's almost back to its IPO price. I mean, it basically went up 3.5x in its first couple of months of being public. And then ever since then, it's just been a straight drop. I'm just thinking, like, I think the market is going to look at these oversold opportunities, and on any sign that things are not as bad as it seems, I think we're just going to see stuff like this absolutely pop. And I also like that you were bringing commodities to our attention, because I had this just sense over the last month. I mean, obviously with oil prices and what we're seeing with Russia, it's obviously been very good for the price of oil, if you like oil going up and if you've been trading those stocks. But I think people are beginning to see that there might be an opportunity in real assets again. So we might expect a drop over the next month, but I think bigger picture, I mean, I've been looking at that chart of, the commodities to stocks valuations for probably the last 5 years now. And it's just kept going down and down and down and down and down. I think commodities are a 50-year low in terms of valuation relative to stocks. But I'm wondering if there might be some turning that we're beginning to see here with obviously the global pandemic and the supply chain shortage. Do you guys think there might be a bigger story here, a bigger case for maybe owning commodities over the next few years?
I mean, yeah, I think that the case is there. Inflation's great for stuff like commodities. I mean, prices are going to be going up. It's going to create for, basically arbitrage opportunities for the companies that are going to be hedging prices, but then they're getting higher prices for this, and they got to raise prices and pass it on to consumers. And that's basically what inflation is. It means that they're able to pass the higher cost onto the consumers. So it ends up being great kind of for the commodity aspect of it. And then, yeah, this could be the start of a pretty major shift that we're seeing.
Gotcha. But commodities have always just been some of the most volatile, assets, which makes them great to trade. Like I've seen people create option strategies purely around trading commodities because they're so cyclical, they're so volatile, they are prone to just very, very large moves, both up and down. Mike, I saw you go off mute. What's your take on commodities?
Yeah, I mean, looking past the tragedy in the Ukraine, somebody's going to have to rebuild it. The country is devastated, and that is bullish for commodities. We're going to have to get in there with an awful lot of building materials, and you're going to just divert resources to it. Supply chains are already stretched, so the fact now that you need even more basic materials, along with just, you're losing a lot of wheat production, because let's not forget, Ukraine is the largest wheat producer in Europe. So
I was just talking to one of our editors over at Money and Markets. I know you guys both contribute to them. And he was talking about how high wheat prices are right now. I just thought this was hilarious. Like, here's something that people have been ignoring for years. It's wheat. No one's talking about that. They're talking about innovation. They're talking about technology. Now we're seeing opportunity in commodities like wheat. I think the market is in some sense waking up to the fact that these intangible assets, these innovation, these like very advanced technologies that are becoming more real, but still not very real. I think people have forgotten the beauty of physical, real assets where money's been made for thousands and thousands of years consistently.
Yeah, I mean, we've got to replace that loss there. And that's going to divert a lot of stuff that's already in short supply, because it's going to be a crisis. We've got to get the material into there. So, it's going to be inflationary, but you're also going to have opportunities in commodities. One of the ironclad rules in economics is when somebody suffers, somebody else profits. And unfortunately, we're seeing that on a massive scale right now.
Yeah, absolutely. I hear you there. Yeah, I've been making a contrarian move the last couple of days. I decided to start buying up some of those beaten down Russian stocks before the New York Stock Exchange delisted all of them. It's because when I look at it, it's just like, on the one hand, I almost don't feel good buying stocks that have to do with a country that arguably might be committing war crimes at the moment, but at the same time, I need to make money back. So I try not to make myself feel too bad about it, because I think some of those stocks, we saw Russian stocks drop, 50 to 90%. Some of their biggest names, like their Google equivalent, their biggest bank, so their oil plays, et cetera. So yeah, I agree with you. I think we have to go where the opportunities are right now. I mean, I said at the beginning of the call, I've had a very rough couple of months because I've been for so long, I've personally been very bullish on small caps. I've been bullish on cryptocurrencies. I think we're seeing opportunities for really good bounces right now. That's why I'm drinking from my mornings are bull mug today, because I am short-term bullish, and you guys have been confirming a lot of things that I've been kind of sensing in the market. I think you've given us a lot of really, really cool opportunities to trade this month. I think this could be a very, very good month for our True Options Masters. So I encourage everybody who watched this video, keep reading your emails. They're in your inbox every day at approximately 11 a.m. We've even revamped our schedule to make every day have its unique identity so that you know what is coming each and every day. We're going to be talking about charts, how you can do technical analysis. We're going to be covering options 101 basics for those of you who need some help there. Chad's going to continue with his stock analysis on Thursdays, bank it or tank it. Mike's going to give you big picture stuff on Fridays. We've got our new options arena where our other master, Amber Hessel, has been kicking all of our butts with her analysis. People keep voting for her, and we're going to get her on these market outlooks starting next month. I meant to do it this month, then I took a short vacation to the mountains over the weekend, and another month crept up on us. But want to thank you guys for your time today. I want to thank all of you for watching at home. Again, if you like this video, please like it, comment on it, and please subscribe to our YouTube channel so we can get True Options Masters out to more and more people. Seriously, I trade these guys' suggestions almost every month, and I've made very good money doing this. So they've given you a bunch of opportunities to trade, buy shares of the stocks if you want. I don't recommend shorting them. Like, it's a little complicated. You can buy put options on some of the bearish opportunities Chad recommended. We saw a big move in commodities last month, which means things revert to the mean. We could see them drop this month. So, hey, and if you guys make some money from these opportunities, please come back to this video, leave a comment, tell us how you did. I really do hope some of you take advantage of the opportunities we've shared today. So with that said, we'll be back with another market outlook next month. We're going to be in your inbox every day if you're subscribed to our e-letter. And until then, ciao.